Good evening, everyone. My name is Maurya Hanspal, and in this session, we're going to continue the sessions on financial literacy, like wherever we left. And in this session, I'm going to talk about three terms. First term is, yeah, first term when we talk about it is a risk averse person. One is a risk taking person, or we can also call him as a risk tolerant person. And somewhere in between, you have a risk neutral person. So in the previous session, for all of you who attended the previous sessions and who did not, can watch it from the YT live recording. We were talking about investments in equity markets or in stock markets. So when we talk about the people who are investing into the stock market, we can categorize those people into three types. One is a risk averse, one are the risk neutral, and one is the risk taking and the risk tolerant. Okay. So firstly, let's start with the third category to make it quite easy for you to understand, since we're talking about the most risky investments, that is equity, right? A risk-taking person or a risk-tolerant person is someone who is a person who likes to take risk in the stock market. Because the basic principle of finance or the basic principle of the equity market or stock market is higher the risk, higher is the expected return. So this person will have a larger proportion of his investments or a larger proportion of his portfolio or a larger proportion of his mutual funds into equity. For all of you who still do not know that what is the difference between trading and investment, what is a portfolio, what is a mutual fund, you people can watch all my previous recordings which are available on stock markets, on wealth management, on mutual funds, investing, trading, everything. Okay. So when we talk about the risk-taking people and the risk-tolerant people, since these people have an appetite to take risk, a larger chunk of their money or a larger proportion of their money is invested into equities because equities are the most risky. I'm not taking into consideration the cryptocurrencies right now because the cryptocurrencies are something which is hugely volatile. Okay. So taking that out from the purview because the cryptocurrencies have no fundamentals, but the stock markets have fundamentals. And we can predict the growth of these stocks and we can talk about the fundamentals of the companies, how strong they are. But in case of the cryptocurrencies, we cannot. So I'm talking about just the equity market. So why the equity market is risky? Because in a period of boom, the stock market will rise. In a period of consolidation, the stock market would move in the same pattern, that it would neither rise nor fall. But when the recession comes, at the time of recession, you do not know when the stock market will fall. The same thing happened in the COVID-19 pandemic in 2020, I'm talking about. In 2020, when the market was on a rise. So the cases were also on the rise, but the market was also on the rise because people started to take it. Even in the third wave as well, like which was smallest one. So the first one, everyone was not prepared and there was panic selling in the market, right? Because as we talk about the different phases of stock market, first we have the displacement phase. So what exactly is the displacement phase? In the displacement phase, when the market has crashed or like when the market has come down, the stock prices are quite cheap. So people buy the stocks when they are cheap. So displacement is a phase when the market has fallen and the market can rise from that point. So at that down point, the people start to buy. You see, the market has fallen. At this point, the people would start to buy. So when people would start to buy, they will start buying it, they would start buying it. So all those buying would take place here. So after the displacement phase, then you'll have the buying phase, right? And after the buying phase, you will have, then since the people will start to buy, the market price would rise. Once they will start to buy and the market price would rise, it's fine. But at a point will come when the market would be excessively valued. And that is your euphoria. Because people are like investing into market, right? And the market will reach excessive valuation. When people realize that the market has reached excessive valuations and stock are not following their fundamentals, some profit taking will happen and the market will start to fall from here. And when the market starts to fall and people start to realize more and there is some adverse news, some negative effects, the interest rate rising or some natural calamity happening, it's a crash. And that we call it as panic selling. Okay, so in case of the profit taking, the market can correct. In case of the panic selling, the market can crash and cause a recession. And that is why the equity markets are very risky. You do not know when the market would rise or like when the market would fall. But in the long term, the portfolio would give you return. So that is for the long term basis. So more than I say 80% or 85% of the investments by these people who are the risk taking and risk tolerant is made in the equity markets. Okay. The second thing when they talk about is they talk about the risk averse. The risk averse are the people who are risk intolerant, who are not willing to take high risk in the market. These can be those people who invest a smaller proportion of amount into equity and a larger proportion into debt instruments because debt give you a fixed rate of return. Obviously, the debts can also be risky if you are like investing into the lower grade bonds and all. But these people try to invest in the highest grade securities. So the debt proportion is more than 80 to 85% and the equity proportion is less, like just 10-15% or maybe less than that. Because these people want a fixed rate of return and they do not want to take the risk in the market. So that is the first condition they want to take into consideration. So what basically happens when we talk about the risk taking person or the risk tolerant people, these are those people who are the young investors, maybe the early 18, 19, the early 20s, or maybe early 30s max to max. That is like before 35 years of age. Like because at that point of time, people are just married and their salary is growing and they have the risk appetite and also the time to earn. Even if they lose in the stock market, they have the time to earn because they are young and they can work harder, they can switch jobs, like do multiple jobs and all these things. But a risk averse person would be someone who is at the age of retirement, maybe like he has crossed the age of like 40 years, the early 40s, 50s, 60s, or even like retirement. Because at that point, the person after the 40s or in late 30s, these people are more concerned about the wealth accumulation or the capital preservation. All the amount that they have earned in the past 15 to 20 years, they won't like to put it at stake. Because at that time, people are at the peak of their career. They want to build their own homes, their own houses, have a car, and like fund for their like students' education, fund family, and all those stuff. So at that point of time, the goal would be the capital preservation. But a risk taking person or a person who is a risk tolerant person and wants to take risk, at that point of time, his goal might be to for growth and capital appreciation. Growth and capital appreciation. But the risk averse person might want the capital appreciation and continuous income or dividend. कि एक fixed income भी मिलती रहे after retirement. But when we talk about a risk neutral person, a risk neutral person is something which combines both the risk averse and risk taking. It can be the like 60-40 in debt and equity or 40-60 in equity and debt or like 50-50 in both of these. So that person is mainly concerned for both growth, capital appreciation and the capital preservation as well. So this person can be anyone. Either like this person can be in the mid age group of like 35 to 40. But one thing I want to clarify, like there is a huge assumption or huge stereotype or stigma in the people that they think that the people who are the risk averse, who are like unwilling to take risk in the stock market are always the old ones only. The people who are in early 40s or 50s or 60s are at the verge of retirement. And people who are the risk taking people or the tolerant people are those people who are the youngest generations. That's not always true. There are people who are at the age of 50s or 60 who still want to take risk in the stock market, who still have their portfolio of more than 60, 70, 80% in stock market. And there are still people who are in 18, 19, 20s, 21 who have been allocating their wealth to multi-asset funds in equity, in debt, in gold. Right? So it is a perception that people who are the old ones will always invest in the all kind of or the maximum proportion in like debt instruments, or people who are the risk taking or the young people who are the young people only. No, it can be vice versa as well. So one thing is be it you invest more than 80% to 90% in equity or more than 80% to 90% in debt or 50-50% in both of these, your portfolio management must be clear. You must focus on everything. You must focus, and your asset allocation must be quite appropriate. Like, for example, if the equity market is falling, then your equity market stocks must be quite diversified into different industries. If one industry is falling, the other industry is giving you return. Even if the interest rates are rising, your market to market bond ka price to kam hoga, right? But still, your equity market portfolio, it must sustain. If the yields are falling and the equities are also falling, your bond portfolio must sustain. And if there is inflation, if there is some geopolitical tensions, as we can see right now in case of the Russia and the Ukraine crisis, gold investment is the best one. So your portfolio must be in such a way that you can balance it out in each and every way. So that is the first thing which you must keep into consideration. It is completely upon you. If you can take a complete risk in the market, whole risk in the market, and invest in just in equities, then go for an equity portfolio only, right? If you cannot take the whole risk, go for a whole bond portfolio, or like matlab ki more than 80% or like 50-50. But I would certainly suggest you do not go for 100% equity or 100% debt. You can go like 50% debt equity. You might avoid gold. It is not mandatory to invest in gold, but if you particularly talk about your debt and equity, at least you must have some proportion. Or it should not have been key like you have just one mutual fund for equity. That's it. You can have one mutual fund for equity, but also have like one mutual fund for equity and debt, or like one whole for debt. At least some balancing out would be done. Okay, so keep it as a balanced portfolio, a good portfolio. And this risk taking, risk averse, and risk neutral, agreed, it might be a theoretical concept. But in the practical scenario, you are investing. Your books, your teachers, your friends are not investing for on your behalf. It's your decision. You have to invest on your own. You have to see your risk appetite. Whether you are of 20 years of age or 30 years of age, 60 years of age or 90 years of age. It's your risk appetite. You have to open your eyes and ears and you have to invest and wherever you want to. Invest in equity or bond or anywhere that you want to. It's completely all upon you. So these categories are the good one just to understand finance, but ultimately the financing decision is ultimately all upon you only. Okay, so do not panic. Like, do not go for all these things of like displacement, because people think that when the market will go with the phase of displacement, or when the market has crossed the stage of like profit taking, it means the correction has been done and market is below and it is like time to buy. और लाइक व्हेन देयर इज पैनिक सेलिंग, कुछ मार्केट में कुछ बहुत ही गलत होगा, मार्केट नीचे चली जाएगी, स्टॉक प्राइसेस बहुत कम होंगे, हम तब खरीदेंगे. इट इज नो बैड टाइम और राइट टाइम टू इन्वेस्ट इन मार्केट. स्टार्ट इन्वेस्टिंग एनी टाइम. Because obviously if we have seen like in the COVID time the market was all down and जो gains मिले हैं more than 200%, वो हमारी बाद की जनरेशन को तो नहीं पता. If someone is starting investing right now and he has attained the age of 18 years when the market crossed 60,000, at that time for him like was the right moment. Usko nahi pata, because it's not his fault that he became as a legal investor after this COVID-19 pandemic wave ended. No, because 60,000, because like before the market was at 30,000, 40 पे, 50 पे, 60 पे आई. It is predicted कि 1 lakh पर भी आ जाएगी after like 5 to 10 years from now. So that one thing should be kept in mind. Okay, so that was